Some of the smartest money in the world is quietly preparing for silver to explode. Not to $50, not to 100, but to numbers that sound completely insane. Because what if $500 silver isn't crazy? What if it's actually a warning sign? Right now, most people think silver is boring. It's cheap. It barely moves. It's that dusty coin your grandpa kept in a drawer. But behind the scenes, something very different is happening. Big investors are loading up. Central banks are hoarding metals. Countries are fighting over supply. And almost nobody is paying attention. In this video, I'm going to break down why some serious investors believe silver could go vertical, where the $500 idea really comes from, what has to happen for it to even be possible, and how normal people can think about this without blowing themselves up financially. And stay with me until the end, because I'll show you a simple way to know when silver is getting dangerously overheated before most people even notice. Let's start with the obvious question. Why would anyone even say $500 silver? That sounds like something you'd hear in a late night ad. But it actually comes from something very old, something boring, something most people ignore. For thousands of years, these two metals have moved together. Different countries, different empires, different currencies, same pattern. Gold and silver act like two kids tied together with a rope. Sometimes gold runs ahead. Sometimes silver runs ahead. But over time, they keep getting pulled back toward each other. That rope is called the gold to silver ratio. It simply means, how many ounces of silver does it take to buy 1 ounce of gold? In ancient times, it was around 12 to 15. For a long time in history, it stayed near that range. Today, it has been over 80, sometimes over 90. That means silver is extremely cheap compared to gold. Historically cheap. And whenever that gap gets extreme, silver tends to explode later. Now add the second piece. Gold itself. We live in a world drowning in debt. Governments owe hundreds of trillions. They can't pay it back, honestly. So they print slowly, quietly, constantly. Every time they do that, money loses a little power. You don't notice it daily. You notice it at the grocery store, at the gas pump, at rent time, over decades. It's brutal. That's why central banks have been buying gold at record levels. Not talking about it, not advertising it. Buying it quietly. China, Russia, Turkey, India. They're stacking physical gold because gold is money without permission. No counterparty risk. No app. No promise. Just metal. Some analysts believe gold could go much higher over the next decade as trust in paper money keeps fading. If gold goes high and the gold to silver ratio goes back to normal, the math gets wild. Gold at 5,000, ratio at 15, that's over $300 silver. Push either number further and suddenly 500 isn't a joke anymore. That's where the idea starts. But silver isn't just small gold. This is where it gets interesting. Silver is not just stored. It gets used every day. Phones, computers, solar panels, electric cars, medical tools, batteries, and satellites. Silver is one of the best conductors on Earth. Modern life runs on it. And here's the problem. Most silver is not mined for silver. It's mined as a byproduct of other metals. Copper mines, zinc mines, and lead mines. They produce silver on the side. So if silver prices double, mining companies don't instantly double production because silver isn't their main business. Supply is slow. Demand is rising. That's a dangerous mix, especially in a world racing toward green energy. Solar panels alone use massive amounts of silver. As countries push for net zero, demand keeps climbing. At the same time, good mining projects are getting harder to build. Permits take years. Environmental fights local protests, court battles. A mine that used to take 5 years now takes 15. Some never open at all. So you have rising demand, slow supply, and money printing. That's the setup. Now let's talk about the deeper problem. The system itself. After World War II, the US dollar became the center of global money. Oil in dollars. Trade in dollars. Reserves in dollars. For decades, it worked. Now it's cracking. Sanctions, frozen reserves, trade wars. Countries are realizing something uncomfortable. If your money lives in someone else's system, it can be taken. So they're diversifying. More gold, more bilateral trade, less dependence. This isn't anti-America. It's self-protection. And when trust in paper systems drops, hard assets rise. Always have. Now layer on what some people call a commodity supercycle. For years, money flowed into apps and software. Now it's flowing into physical stuff again. Copper, uranium, lithium, and silver. You can't build data centers without metals. You can't build grids without metals. You can't electrify everything without metals. But you also can't create mines overnight. That delay creates shortages. Shortages create price spikes. Silver sits right in the middle. Investment demand, industrial demand, both pulling at once. That's rare. That's powerful. Now here's where things get intense. There is a quiet war for metals happening, not with tanks, with contracts. China finances mines in Africa, gets guaranteed supply. US companies lock in long-term deals. Countries buy entire projects. They're not buying metal, they're buying future metal. That tells you something. They're worried. They're thinking long-term. Meanwhile, many Western countries are slowing themselves down with red tape. Projects get stuck. Capital leaves. Supply tightens. Again, more pressure. So how do you actually get to 500? It comes back to cycles. Look at past silver bull markets. The 1970s, 2011, same pattern. Gold moves first. Silver lags. People ignore it. Then suddenly, silver explodes. In 1979, silver went from 6 to almost 50. That's over 700%. In 2010 and 11, it went from under 20 to almost 50. Then it crashed. Why? Because silver has leverage built in. It's a smaller, thinner market, less liquidity. So when money rushes in, prices fly. Think of gold as a cruise ship. Silver is a jet ski tied to it. When the ship speeds up, the jet ski launches. That's torque. Great on the way up, terrifying on the way down. Which brings us to the danger. This is not a safe fairy tale. Silver destroys people in every cycle. Late buyers, leverage users, and emotion traders. They see headlines. They chase. They buy tops. Then panic. Then sell bottoms. No target is guaranteed. 500 is a scenario, not a promise. Now, how do smart investors play this? They think in layers. Some own physical metal, no counterparty risk, no apps, no leverage, just insurance. Some own miners, higher upside, higher risk. Some use ratios. When gold to silver is high, silver is cheap. When it's low, silver is hot. It's not perfect, but it's a compass. Most importantly, they size correctly. Not all in, not bet the house. Enough to matter, not enough to ruin them. They survive volatility because silver will test you mentally, emotionally, financially. Now let's put it all together. $500 silver comes from massive global debt, money printing, central banks buying gold, industrial demand, slow mining, geopolitical stress, extreme ratios, all pointing in the same direction. not certainty, possibility. And possibility is enough for big money to prepare. The question isn't, will it hit 500? The real question is, what happens to your life if money keeps losing value? And do you own anything outside that system? Because silver isn't about getting rich quick. It's about surviving slow decay. Are you thinking about converting your IRA into a physical gold or silver IRA? Click the link in the description to get your free copy of the Gold and Silver IRA Guide and discover the saving secret thousands of Americans are using. And if you want to stay ahead instead of reacting late, like the video, subscribe to the channel, and hit the notification bell. This channel is about seeing moves early, and I want you here for all of them. See you next time.
Could we be in the early innings of a massive commodities bull market? Let's dive into what the experts said at VOIC 22 about it sits.
At the Vancouver Resource Investment Conference, William Middlecoop and Michael Gentile made a bold claim. We're just getting started on a multi-decade commodities bull run.
Middlecoop highlighted supply, demand imbalances, especially for silver. He argues that silver's industrial demand will outstrip supply. Michael Gentile doubled down on junior miners, calling them the opportunity of the decade due to underinvestment. So what should we take from this bullish call? I'll break down potential scenarios. What to watch if you're considering silver or mining stocks. Whether they're right or not, the key is to stay informed and balanced. What's your take?